So this is very powerful. It's not really talked about. It's buried inside of the US tax code, but there is a part of the tax code that is specifically for small business owners and pension plans. And it's defined benefit plans such as cash balance plans or 412(b)(3) plans. And with these plans, you're able to create your own pension. And with these pension plans, the way that they're funded is using pre-tax business profits. Okay, so this is very, very powerful. And I'm going to dive into this more later in the video, but I'm going to touch on it now. If you're making significant profit in your business and you're behind in retirement, you want to catch up in retirement, this is such a powerful strategy, because instead of sending those dollars off to the IRS in the form of taxes, you can redirect a portion of those tax dollars into your own guaranteed pension plan or guaranteed retirement plan. And I'm going to dive into that more in the video. But in simple terms, you can take a chunk of your profit, put it into one of these plans, you get a massive tax deduction today, okay? That's very powerful, a massive tax deduction today, and then in turn, you're building a guaranteed retirement plan for yourself later down the road. So very, very powerful. You're getting a tax deduction, saving tens, maybe hundreds of thousands of dollars this year, and instead of sending that money off to the IRS, you're sending it up to your own pension plan that you're creating for yourself, okay? So point number 3, what makes all of this guaranteed? I've been saying that throughout the video so far, guaranteed, guaranteed, guaranteed. It's because it's using insurance contracts. So these plans are not tied to the market. Cash balance plans, you can have money elected to the market, but what we're focusing on is not tying anything to the stock market. It's all using insurance-based contracts because we want the guarantees, we want the predictability, and we want the certainty in our retirement income. So where the guarantees are coming from are either annuities or whole life insurance or a mixture of the two. With these plans, you can either do all annuity, so you can have all of those contributions just going to annuities, or you can do a mixture where it's half and half. Commonly, you'll see about a 40-60 split, so like 60% of the contribution would be used to fund the annuity portion, and then the remaining 40% would be used to fund a whole life insurance policy. Now, the two things in common with the whole life and an annuity is they're both guaranteed. They have built-in guarantees, and that's what allows us to see exactly how much you're going to have in retirement income when you go to retire. Because if you're getting a fixed rate of 3%, let's say, you're able, and you're funding it a certain amount each year, you're able to extrapolate out and see exactly how much money you're going to have in retirement, which is very important. And that's the power of doing this strategy, is we don't want the stock market volatility. This isn't meant to compete with other, or replace rather, other investment accounts you have either. You may have, 401k, profit sharing plan, traditional IRAs, whatever it might be. That's fine, that's great, but this is a way to lower your business taxes, right? And then use those dollars to fund a guaranteed retirement plan that's not tied to the stock market. So you're diversifying your retirement and also saving a lot on taxes this year and following years to come, okay? So that's essentially how these plans are designed. It's using insurance-based contracts that have guarantees built in, okay?